Hello, everyone. Thanks for attending our webinar today. Just wanted to let you know that we'll go ahead and start this presentation in about 15 minutes. Be back with you soon.
Hey everyone, thanks for joining us today. It's a couple minutes before the top of the hour, so we're going to give it just a couple more minutes and we'll get started straight away. So stay tuned.
Hello everyone. Thanks so much for attending our webinar presentation today, Sales and Use Tax Compliance for Dummies. It's a beginner's guide to everything sales and use tax, but when I say a beginner's guide, we have a lot of tips for the veteran pros as well. I think it's something that everyone will get a lot out of. We've got an excellent presentation today, an excellent presenter. We have Mark Giddens, tax technology expert here at Avalara, and he's going to be going over some great things to know. I don't want to steal any of his thunder, but before I pass over the mic to Mark, I just wanted to go over a couple quick housekeeping items. There are two ways that you can listen to this presentation. By default, it is through your computer speakers, but if you need to listen by phone, just go ahead and click on the Listen by Phone button on the left-hand side of your screen. By default, everyone will be muted, so I only ask, please continue to stay muted so we don't have any echo. If you have any questions, please, right below that, there is a little question button, and you can submit those. We have quite a few people registered for this webinar, so we probably won't be able to get to everybody's question, but we'll do our best. And Mark is a very knowledgeable guy, and he'll be able to answer a lot of everyone's questions. And under Event Resources, which is right below Questions, that is where you can access a PDF of the slide presentation. So if you would like to follow along with that, feel free. And one last little reminder before I pass over the mic, you will have access to the recording of this presentation. You should receive it as early as tomorrow afternoon once it's processed. So if you miss anything today, no worries. You will have time to listen to it later. So without further ado, I'm going to pass the mic over to Mark, and take it away, Mark.
Thanks, Morgan. And I want to thank everybody for joining us today for our webinar, Sales and Use Tax Compliance for Dummies. I'm excited to present on the topic. I'll just give you a Cliff Notes version about myself. I've been in the accounting technology and tax technology space for close to 17 years now, and I've had the pleasure of working with hundreds of companies across a variety of industries, helping companies best utilize their systems to automate different processes within their business and limit risk and exposure. Specific to today's presentation, I'm going to cover an agenda here. We're going to talk about a lot of topics and a lot of fundamentals that you'd want to be aware of related to sales tax. We're going to start off and kind of talk about what's the big picture and why sales tax matters. We're going to cover concepts like nexus and product taxability. We'll talk a little bit about the forgotten tax, use tax, and we'll spend some time on exemption certificates. We'll talk about audit prep and planning. We'll talk about specifically what's going on with services in the tax world. And additionally, we'll talk about sourcing of various taxes. And at the end, we'll talk a little bit about how companies are dealing with this from a technology perspective. As we get started and we talk about why sales tax matters, let's spend a few minutes talking about where states are at with their budgets and what sales tax means to them. We'll talk a little bit about compliance challenges that are passed on to businesses that are required to collect taxes. And we'll talk about how companies try to address it and the impact on their businesses and what it means to do business as usual. You know, a study was done a couple of years ago. It was a survey of various states in regards to their budgets. And the culmination of that survey, the result of the survey, was that 31 states had projected budget deficits coming into 2013. And that's pretty significant. When you add up all the budget deficits across all those states, you find that the total amount of money that states were projecting shortfalls for was $55 billion. And it's no surprise that sales tax has become a really important topic. If you look at this slide, when you add up general sales tax and tax on gross receipts, for the average state, that's about 47% of their total state revenue. When you look at a state like Washington State, where we have no state income tax, sales tax becomes even more relevant for states. This is a key way for states to raise money and bring in revenues, and it's also one of the tools that they have to try and shore up those budget gaps that they're all facing. What it means to you as a business, and when we look at sales tax compliance challenges, it means that sales tax is not really a choice for you. Sales tax is a statutory requirement. It's the reason why we all collect tax. If it was optional, I doubt any of us on the call would do it. And the challenge with that is not only is it something that you're forced to do, but you also take on a certain amount of risk in doing it. The state expects you to understand the statutes, the legislation. They expect you to be very accurate in terms of complying with those standards. And what it means to companies is that audits frequently result in back taxes, penalties, interest on top of the fines that are levied. In addition, for companies to comply, the old approach, the manual sales tax approach, you'll find it to be very labor intensive. It's just by the vast number of jurisdictions and the lack of parity of the way that states deal with taxes, it becomes a very complex issue that requires some expertise to do accurately. And what most companies find is that regardless of the amount of work they put into it, human error leads to mistakes, it leads to inaccurate results, and it creates a cost in the business around compliance. And the other thing that's challenging about sales tax in particular is that it's constantly changing, it's constantly evolving. I think you'll get a taste for that in today's presentation. But just to give you an example, in 2014, there were close to 14,000 rule changes related to sales and use tax in the United States alone. If a company is managing sales tax, the other point to point out is that close is not really good enough, but what is the reward for being accurate? Certainly companies are not competitive standouts, or their customers don't get excited when they do tax correctly. It's expected of you, it's required of you, but at the end of the day, it's very clear that it doesn't contribute to your bottom line. So why is sales tax so complicated? When you look at the vast number of variables and parameters in place that you have to manage to get tax right if you were collecting all across the country, we have 150+ million mailing addresses. Within North America, there's over 12,000 taxing jurisdictions. You've got 35,000+ different rules around sales and use tax and rental rates for these various jurisdictions. You have 30 million product and service exemptions related to the way that the things that you sell are taxed. And on top of that, you've got buyers by nature of what type of organization they are or the way that they're using a product that have customer-based exemptions as well. So it's a pretty challenging, complex area for companies that requires some expertise and for many requires a lot of research. Just to give you an idea as far as how this impacts businesses and what it means for you in terms of doing business as usual, with all these changes going on, there was a couple of surveys done by the Wakefield Group and Aberdeen Research, and there were some interesting questions that were posed to survey respondents. One of the questions was, because so many of these changes occur on a month-to-month basis and over the course of the year, one of the questions was, when was the last time that your company updated your sales and use tax processes? And surprisingly or not surprisingly, depending on your perspective, 44% of companies can't remember the last time they updated their sales tax processes. Factor in on top of that, if you ask companies how confident are they that they're doing the right things, nearly 48% of businesses believe that if they were to go through a sales tax audit today, the auditor would find a mistake. And that can be really challenging for businesses because when you look at the impact to the bottom line, the average total cost resulting from these surveys, the average total cost of an audit for a business is north of $100,000. And I don't know about your business, but for most businesses, that's a significant unplanned business expense, and it certainly impacts the health of the company, and it could be a serious setback for companies that go through even a single state sales and use tax audit. In terms of paying attention to what it means to your business to be sales tax compliant, included in the surveys was how much time spent on the various taxes that are required to achieve compliance, and think about the discrete activities that are involved in terms of being tax compliant. Companies have to research tax rates on Department of Revenue websites. They have to build that tax content, the various tax rates for the jurisdictions, into their accounting systems, e-commerce systems. They have to research as well what's the implication of the items and services that they're selling. They have to manage, store, and collect the appropriate customer exemptions. They then have to file returns. They run reports. They fill out forms. They cut checks. They pay states. And what you'll find if you add up all those activities, that the time involved in being tax compliant for most small and mid-sized businesses accounts for about 2 months of full-time work just to be compliant. It's pretty staggering when you actually look at the research. That's 302 hours annually that companies lose to doing manual tasks related to sales and use tax. So this is a challenge that creates a certain amount of risk, and it also creates a certain amount of effort for a company to be compliant. And one other snapshot of activity, one of the areas that companies spend a lot of time specifically is specifically around compliance, filing and paying their taxes. If you look at that specific activity, you'll find that companies spend upwards of 11 hours a week over the course of the month to do their sales and use tax returns. So this is a challenging issue for companies. It requires a lot of work in terms of this moving bar as far as what is compliance. But we're going to spend a little bit of time talking about the fundamentals, the concepts, the things that you need to know to be tax compliant. And as a technology company, Avalara, works with a lot of businesses, and we provide technology to companies to automate their sales tax processes. But inevitably what we find is when we're talking to companies and they're looking at outsourcing or automating their sales tax in their business, they start to ask some questions, and some of the questions come down to understanding basic tax policy or tax strategy. And the concept that inevitably comes up, or the question from the customer, is, what is Nexus and why do I care? In other words, where should I be collecting? What do I do when I collect? And this is a challenging subject for companies to get their arms around. We're going to talk a little bit about what Nexus is. We're going to talk about the right questions to ask. And then we're going to talk a little bit about different rules related to Nexus that are changing related to e-commerce, and kind of define that for you. As a starting point, Nexus is defined, most recently the concept of Nexus was upheld in a court decision in 1992, Quill Corporation versus North Dakota. And in that case, what the Supreme Court said, this went all the way to the Supreme Court of the United States, they said that unless a company has created a nexus, which they defined as a substantial physical presence, the company cannot be required to collect the sales tax from a state. So generally speaking, nexus means a substantial physical presence, but there were a couple of things in that law, or that ruling rather, that were left out. And one of those was, okay, so I understand if I have a nexus, a connection to a state, and that's a substantial physical presence, well, gee, what's a substantial physical presence? And what you find is that they didn't comment on that, and the definition of nexus is actually left to state statutes. And states differ to a large degree as far as what they consider nexus. More and more they're getting more aggressive, and things we traditionally thought of nexus have remained in place, but they're augmenting those laws and adding laws to increase the amount of companies that are required to collect. So when we talk about what's a substantial physical presence, and we look at that, again, nexus describes a connection between a state and a business, and if you have a nexus, that requires you, that compels you to collect and file and register, of course, to pay your sales taxes. That out-of-state company must have a physical presence, but that definition's changing. And so, you know, most companies know when they start their business and they talk to their accountant, oh, your headquarters is in Washington State. Well, you need to go out and register to collect sales tax in Washington based on your presence. But they're not always monitoring or understanding what kind of business activities change their exposure profile. For example, most companies know that if they open a warehouse in a new state, or they open a new office, or they own real property, that it's a nexus-creating event, but it's a lot more subtle than that. And here's a list, and this could be a growing list of activities that companies really need to watch out for, because certainly having multi-state locations creates nexus, but there's things that a business can do that create nexus as well that are a little bit more subtle. For example, going into a state to provide services, doing maintenance or repair services, or services especially around tangible property. Owning or leasing real property, of course, would be a nexus trigger, but what about tangible property? Nowadays, fulfillment by Amazon is a really popular way that companies are going to market, and people are understanding and realizing that storing your goods in Amazon's warehouse has created a presence based on the fact that you own tangible personal property in that state. A lot of sales activities and going out into states soliciting business, whether that's your employee, whether that's a contract rep, could be a nexus creating event. Doing things to help grow your business, like attending trade shows and exhibiting, or even attending a trade show as a attendee, can create nexus in different states. Having affiliates, even things as simple as sending your investors to a board meeting in a particular state may be enough that that state would tell you that you're creating nexus and you're compelled to collect and file sales taxes. So this is certainly not an exhaustive list. It's something to get you thinking about the different activities you're doing and if it creates some exposure. But certainly you want to research the statutes of the states and understand specifically for the states that you're selling into, what is nexus, what does it mean for you, and how does this impact your business. These definitions are broadening as we speak. One of the interesting figures that I haven't shared with you yet that I should is that in addition to us remembering that states are at budget deficits, and those budget deficits are in the multi-billions of dollars. A study was done by the National Retail Federation, and they found that the amount of annual uncollected sales tax due to remote selling online, where a company has a web store and they're selling into a state where they haven't created a nexus, that's upwards of $24 billion. This is a lucrative area for states to tap into revenue streams where tax hasn't previously been collected. And of course we know that Quill Corporation defined the concept of nexus, or upheld the concept of nexus, but states are changing their laws. One of the most significant developments is what you saw with the state of New York several years ago, where they passed what we call an affiliate nexus law, or what could be called a click-through nexus law. And what that law said was, regardless of if your company has established a substantial physical presence, if you're selling through affiliates, for example, something as simple as having an affiliate post a banner ad on their website that directs traffic to yours, and you pay a commission to that affiliate, may be enough to create a substantial physical presence for you based on the nature of your business with that affiliate. So as you can imagine, once New York passed a law, several other states followed suit. You had California, Illinois, Colorado, several states with their own version of these bills. 11 states have already passed Amazon laws. But that's not the only initiative. That's not the only thing to keep an eye on. You've also seen at the federal level, the Senate passed the Marketplace Fairness Act. Now that hasn't been ratified in the House, and there's a couple of competing bills. You see Marketplace Fairness Act, and most recently the Remote Transaction Parity Act making their rounds in the House. But what you see is that the federal government's trying to make an attempt to close these loopholes for remote sellers as well. And even if they're not successful, or the states are not successful in passing their own laws, the Supreme Court has been issuing rulings of late that hint that they'd like to revisit the whole issue of online sales tax, because when the Quill decision was made back in 1992, the internet was really in its infancy. We live in a different world now. So I guess from reading this information, the takeaway for me, or what I make of this information, is that more companies will be required and compelled to collect more taxes in more places, just by the nature of how our economy is changing and the amount of sales tax that slips through these systems based on people selling online. One of the things that we did in terms of putting together this presentation is do some research around online sales and what companies are doing. And it's kind of surprising to see that 70% of companies conduct sales online. Of those companies, 47% only collect sales tax in a single state, which means that they're not collecting in states that have passed Amazon laws. They're maybe unawares of what's happened legislatively that impacts their businesses. So if you've understood Nexus and you've applied it to your business and you understand where you're registered to collect and what you need to collect, one of the challenges that companies need to understand is, how do you make jurisdictional assignments? One of the challenges that you have is that companies have used zip code methods historically, and the challenge there simply is that zip codes don't line up necessarily with taxing jurisdictions. We've seen areas across the country where within a zip code you have multiple tax rates, and as I said, tax rates don't necessarily follow zip codes, but these are taxes, not just state taxes for sales tax, but we have county, city, and local taxes in addition to those rates, and it can be confusing as far as how the boundary lines are drawn. I want to give you an example here, because we think that zip codes are maybe a step in the right direction, but they're a bit of a blunt instrument in terms of determining sales tax rates and boundaries. They almost certainly lead to incorrect calculations, and they lull companies into a false security. On the one hand, if you're charging the wrong rate and you're overcharging it, it becomes a customer service issue at best, right? Your customer can tell you you're charging the wrong tax and maybe you can fix that. With so much business being done online, we see a lot of companies worrying about sales tax because a perceived difference in sales tax between them and their competitor, if it's a higher rate, could affect their ability to be competitive in the marketplace. Just to give you a taste of this, what you're looking at in this picture on the right is in Greenwood Village, Colorado. And this whole area has one zip code, but if you look at that taxing jurisdiction, there's actually up to 4 different rates in that zip code. And as you can see, the tax boundaries are not necessarily as intuitive as you would think they are. You have businesses next door to one another. You have businesses across the street from one another that are in different taxing jurisdictions. And of course, it makes it problematic for you to assume too much in terms of aligning zip codes with the tax calculations that you do. Another thing that you'd probably want to be aware of as a business is around product taxability. And we're going to talk a little bit here in this section about why product taxability is confusing. We'll give you some examples. And we'll talk about taxability issues and what industries are affected. You know, product taxability simply is, the assumption is that for most every state, if you sell something that's tangible personal property, the item is taxable. Unless there's a statute or a ruling that says specifically it's non-taxable. The opposite is true for services. Most services are assumed to be non-taxable unless they're specifically enumerated by the legislation or the Department of Revenue as far as being a taxable event. These rules vary state to state. They, again, like most everything sales and use tax, are not uniform. But what you'll find is there's a whole host of industries that have varying taxability rules. And what I mean by that is, for example, if you're a software company, whether you're selling to a business or a consumer with your software, whether that software is canned off-the-shelf software or whether it's custom to a specific customer, whether it is downloaded off the internet or whether it's shipped on a disk, all those factors can impact the way that you're supposed to tax the item, and that treatment varies state to state. We're seeing the same thing with digital goods. You know, 30 years ago, if I walked into a bookstore and I bought a book, unless that book were a Bible or a kind of a religious book, some kind of a religious book, or it was a textbook, generally that would be treated as a tangible good, and those were taxable. But we live in a different world today where what we used to buy in a store when we used to buy stuff, we now buy online. We download books to our Kindle. We download PDFs from websites. And what you see is states trending to make changes. Washington State with Amazon here has already made the change to tax digital goods, but then if you download an ebook or an iTunes song in California, it's still treated as non-taxable. See quite a variance with services, medical devices, food and beverage rules can be very complex. Clothing and apparel, for example, if you buy an article of clothing under $110 in the state of New York, it's considered a necessity and therefore it's non-taxable. If you charge $110.01 for the same apparel item, that now becomes taxable because it's treated like a luxury good. There's various states that have enacted tax holidays where for certain periods of time, things that are normally taxable are not. You see this with back-to-school holidays or disaster preparedness tax holidays, and the list keeps growing and growing. These rules are evolving, and it's always changing. But I want to give you a couple of examples here. Whether these two candy bars are taxable or not actually depends on, in 24 states, whether the item actually has flour as an ingredient. If it has flour in the ingredients list, it's considered a food. If it has no flour, it's considered a candy. And 24 states agree on those definitions, but actually 24 states have different treatments of those items based on those definitions. The other thing that you'll see as an example is that for beverages, for example, we talk about energy drinks, that's a pretty growing market. One of the differences that has to be taken into account as far as whether taxing those items is whether or not it's a carbonated beverage or a non-carbonated beverage with a supplement label. Then it could be taxable, or if it lacks the carbonation, it could be treated as exempt. These are just a couple of examples of the millions of rules that companies need to be aware of. Well, maybe you don't need to be aware of millions of them, but those ones that affect your industry anyways. So it's really important to understand what items are taxable, what services are taxable. We'll talk a little bit more specifically about services later. I want to spend a minute and talk about the forgotten tax, which is use taxes. And to do that, we'll talk a little bit about the difference of sales tax and use tax and what that means. But we want you to understand that it's not just a consumer's problem. This affects businesses as well. Sales tax, by definition, relates to an interstate intrastate transactions. So if I go into a retail store and I buy a bicycle, that's sales tax. If I order a bicycle on Amazon in the state of Washington and they ship it from Seattle to my location on Bainbridge Island, then generally that's considered sales tax. There's a different type of tax that comes into play when we're selling and shipping across state lines, and that's called a seller's use tax. A seller's use tax is an interstate transaction where the seller is actually compelled to collect the tax because they have nexus. I have a Washington business, and I'm selling bicycles. My customer's in Colorado. Because I've attended a trade show there, I've been compelled to register to collect taxes. I would be required to collect the use tax on behalf of the customer as a seller. The difference, and the one that companies are most confused on, is consumer's use tax. And what consumer's use tax is, there's many different types of use tax, but consumer's use tax, what we typically see is when I as a business buy something from an out-of-state vendor, and they're not compelled to collect the tax because they don't have a nexus, so they're charging me zero tax. I as a business need to self-assess and pay the use tax directly to the government. So it's incumbent upon me to understand what items and services are taxable, but then also, if I've not been charged by an out-of-state vendor, to then self-assess and pay those taxes. And certainly there's challenges around use tax because you may buy things in bulk and store them in your warehouse and resell them to other people. But in certain cases, you may pull those out of inventory to use within your business, and that creates a use tax. So transferring items in and out of inventory, providing promotional materials, those could be activities that require you to self-assess and pay use tax directly. When you look at consumers in the marketplace when they buy things online, going back to that National Retail Federation, very few consumers know about use tax, and those that do simply don't comply. From a business perspective, it's really important because this is an area where companies get audited, and they could be assessed fines and penalties and interest. Another tenet of doing sales tax compliance in your business correctly revolves around exemption certificate management. We're going to spend a few minutes here talking about why auditors are very serious about exemptions. We'll talk about what you need to understand and who it's incumbent upon in terms of managing an exemption process and where the burden of proof lies. Generally speaking, collecting certificates is a source of risk for every business. Typically when audits are conducted, auditors are looking for zero tax transactions, and if the reason the transaction, the tax on the transaction is zero, they want to see the appropriate certificate to back that up in an audit. It's incumbent upon a company to make a good faith effort to collect the appropriate certificate documentation, and there's a couple of reasons why companies could be exempt. It could be a customer-based exemption, so the type of entity that the company is or the organization is could be exempt in that state. Now it does vary, but some states you'll see, for example, exempt nonprofits or religious organizations. Government in a lot of states is generally exempt. Certainly federal government can be exempt, but there's a reporting requirement on the actual seller to collect the appropriate documentation from the buyer to make sure that, that they have proven that that transaction is exempt. The other type of exemption that you run into would be a use-based exemption. This is where a company is buying something that typically is taxable by nature, but by nature of the way that company is using it, the sale is exempt. So for example, if I'm buying something as a distributor to resell onto another entity, I would be providing an exemption certificate, a resale certificate, because for those specific items, I'm going to turn around and resell them to someone else, and then that entity takes on the obligation of actually collecting the tax. There's quite a bit of challenges around certificate management because in order to comply with making that good faith effort, there's several steps a company has to do. First, they have to collect a certificate from their customer, but they need to make sure that that certificate's on the right form. They need to make sure that it's completely filled out. Different states have different forms. Companies tend to miss information when they're filling these out. You also have to make sure that those certificates are valid, meaning they've not expired. There's certain states, like the state of Florida, for example, where certificates expire annually. So if you haven't done a sale with a customer in a year, you need to go out and collect a new certificate from that customer. And it's something to be aware of, and I'll give you a thought on the context or the importance of managing these documents in your business. Inevitably, when people are structuring a process around collecting certificate documents, they're using fax machines and file cabinets, and they're building a process to collect paper. And as evidenced by one of our customers prior to using Avalara software, they went through an audit. Northern Tool was the name of the company, and they were missing one piece of paper, one certificate, and it was going to cost them more than $20,000. They went through monumental efforts to contact the company and collect the appropriate certificate, but they had a kind of change of culture, and what they looked at as document management really to them became currency management. And what I mean by that is that if that document represents $20,000 to a business in terms of a fine, they felt that they're now managing currency, they're not managing paper, and it made them question their process and ask, is what we have in place something that's suitable for managing these things that are so valuable to our business when we miss them? We're going to talk a little bit here about audit planning, preparation, audit avoidance. Our strategy, your strategy, is the same. We'd love to keep auditors' pockets empty. And we'll provide you a little checklist here of, are there things that you're doing or not doing that are creating audit risk in your business? One of the things I want to share with you to give you a little bit more context about this topic is that over the last several years, audits have been trending on increasing. And I say that because we've seen announcements from several states that they are hiring auditors. California made an announcement a couple years ago that they were hiring over 100 auditors over the next 3 years from the Board of Equalization. Idaho, which is certainly not the populous state that California is, was experiencing something similar. They went out, they hired 48 temporary auditors to see if they could move the needle on revenue collection in their state. Those efforts were so successful that they kept all 48 auditors on as full-time staff. So not only are audits a little bit dangerous for your business, but the frequency of audits are increasing as states tighten down their enforcement efforts, and you want to make sure that you think about that as you're making your tax decision. Some common mistakes that companies can avoid is, number one, failing to file a return. That tends to put you on the state's radar in terms of failing to be compliant or failing to be compliant consistently. Other things that you want to think about is failing to report your sales accurately. That's a big no-no. Taking excessive credits or exclusions on a return can cause there to be a need to look into these. That raise auditors' eyebrows. Filing returns with errors is never a good thing. I mean, certainly getting a notice from a state that you've made a mistake on a return is not fun, but knowing that the fact that in doing that you're raising the state's awareness of you probably makes you think twice about not spending the effort to do it right. Having returns information that doesn't match other records. Auditors look at different types of information for their state. One of the big red flags that we've seen is when companies' sales tax returns differ in their sales that's reported to their state income tax return. So you want to make sure you're using the same numbers across your business and that there's no discrepancy in your sales tax reporting. One of the challenges with audits is that if you are audited and the auditor finds mistakes, typically states have look-back periods where, for example, in California, they can go back 3 years. But if you go through an audit and California finds you, they'll typically be back every 3 years to review the previous 3 years until you show vast improvement. So just the fact that you've had a poor audit in the past means you may be more likely to get audited in the future. Certainly, if your business is inappropriately using certificates to buy goods, misusing the goods that you reported on a certificate, that can be dangerous. And then, of course, this one gets an asterisk next to it. Not reporting use tax is certainly low-hanging fruit for auditors. It's an area that they really focus in on. So if you're a company and you're trying to make sure that your books are in order and make sure that you're avoiding Audit fines, penalties, and interest. What do you do? Well, here's some ideas as far as how to reduce audit risk. One of the things I'd recommend to companies on this call, if you have not done a nexus analysis yourself or paid an accountant or a state and local tax group to do a nexus study, that's probably in order. You want to review your business activities and make sure you understand the exposure you're creating for your business based on the states that you're making a connection to, based on that state's specific definitions. Certainly you want to stay up to date with rate, rule, and boundary changes. This world of sales tax is fluid. There's a lot changing all the time. Certainly states send out updates, but that's not guaranteed that you get those faxes or emails or letters. So make sure you're staying in touch with the states and understanding what's changing. Make sure and report your consumer's use tax. Again, that's something that can keep you out of a lot of trouble. This one probably sounds like a no-brainer, but we work with a lot of companies that find out at some point that they've been non-compliant in the past. And while they can resolve those issues and they can limit their exposure, and there's different ways to work with states like doing voluntary disclosure agreements, from firsthand experience, that's never a fun process. So as a new business, if you're a new business on the phone, do the diligence, do the research today to be compliant from day one. It's going to make your business so much more relaxed than worrying that the auditor is going to knock on the door one day and you're doing it wrong. And then, of course, we make the advisement here that you'd want to automate with technology where you can to take the human element out so you don't make needless errors in the process. Also, make sure you have an understanding of your filing requirements. Somebody at your company is going to need to build a filing calendar to understand what returns are due, when they're due, what forms you're required to fill out. Make sure that you don't rely on zip codes. Do a little bit of additional due diligence to make sure you're making rooftop level calculations, you're accurate in performing the right sales tax. Not only will it keep the government off your back, but your customers will appreciate it. Make sure that you do research when you go into new states of how the items and services that you're selling are taxed. And you know, it's surprising, but in many audits, companies fail because they simply can't produce accurate sales records to auditors. That's probably, again, a no-brainer, but just don't make the mistake. Make sure that you're documenting all this when you're exempting tax or you're not charging tax on items and services. And then make sure that you put a little thought into a process of what's the right way for your business to manage and collect and store certificates so you have those accessible in the event that, God forbid, you go through a sales tax audit. One of the things we wanted to point out here at the end is that there's a lot going on with services. You know, our economy has moved from a economy where we used to sell stuff, and you can see that based on the sales tax laws that are out there. You know, sales taxes started getting passed in the 1930s. At that time, we were a manufacturing economy. A lot's changed, right? Services are now we're moving to a service-based economy where things that we used to buy as tangible goods are delivered in a different way, or we're outsourcing services. It's important to understand what's taxable and what's not from a service perspective, but also what's changing and what's likely to change, and also, you know, knowing what that means to your business. And so, you know, the general assumption that services are non-taxable is a fallacy. Services can be taxable, but certainly they're not always taxable. In order to understand how to tax services, if your business is a provider of different types of services, is you want to understand the difference between the way states look at tangible personal property, services associated with tangible personal property. You want to understand how states look at real property services. You know, if you're doing services related to real property, there may be some differences there. Also understand the difference between professional services, because services is a pretty broad topic nowadays, and it requires some specificity to intelligently understand what your requirements are. And again, just like products and items and goods are taxed differently in different states, and there's a lot of nuance there, states often define the taxability of services differently as well. Just to give you an idea, here's some services that are commonly taxed. So amusement parks, if you go buy a ticket and attend an amusement park, that type of service is largely taxed throughout the country. When you buy your cable television, there's many states that tax that. Telecommunications is taxed in nearly every state. You've got information services, data processing services, repair and maintenance and warranty services, remodeling services. There's many states that tax these types of things, and as evidenced by this slide, You can see that if something's TPP and it's not a special good, it may be a little bit easier than services, but services specifically enumerated by the Department of Revenue create some challenges in terms of digging into the details. I wanted to point out some states and kind of what the trend is there. What you see is that all states that impose a sales and use tax impose its tax on some level of services. States that tax many services, Connecticut, Hawaii, New Mexico, South Dakota, and West Virginia. But there's also states that don't tax many services, like Alabama and Florida and Oklahoma, etc. Those trends are likely to change. What we've seen a couple of years ago, the state of Minnesota passed a law to begin taxing business services. And nearly every time that the budget comes up in California, there's talk of taxing services. This is a popular topic for politicians to expand the tax base to shore up their budget gaps. And it's likely that you'll see more and more services, especially in growing areas of the economy like cloud software services, or different technology services that are already starting to be legislated against. A further nuance to taxing your sales to the customers appropriately is thinking about bundled transactions. You could potentially have a bundle which represents a series of items that aren't separately stated on the invoice that creates some big tax implications for yourself. Maybe you're selling different items that have different tax implications in a bundle. Maybe you're bundling products and services under one bundled cost. And that can create some challenges because states kind of take a dim view of bundling. But as services take on a larger role in our commerce, more transactions include an element of a service. And standalone services, as they're separately stated, they present some challenges. Again, different states have different opinions on this, but only with bundling you can complicate this even more so. When you add TPP to the mix or a variety of services, it definitely creates some challenges. The state's issue is they want to make sure that they understand what you're selling and they get every dime in tax that's due them. When you're bundling transactions, it makes it a little bit more difficult to understand the implications of what you're selling. A final piece here that we'll roll into before we open it up to questions is around sourcing tax. And what you'll find is that there's different methods for sourcing tax, what we call destination-based sourcing and origin sourcing. And from a fundamental perspective, what we mean by an origin address is a ship-from address or a warehouse location where you're shipping your good from. A ship-to location is typically what we mean when we say the destination. And when you're providing services, generally if those services are on site, that would be the destination of those services as well. The good news is over the last several years, states have moved to a more uniform process around this. Most every state nowadays, or the majority of them anyways, have a destination-based model, which means that when you sell into that state, you're required to collect the tax based on where the product is being shipped to. But there are some outliers. There's some states like Illinois and I believe Missouri that still have origin sourcing where you base the tax not on where your customer is, but where you are as a business. And that certainly applies to in-state transactions. One of the things I want to point out here is that from a out-of-state transaction perspective, if you're a remote seller, you're shipping across state lines, it is uniform that you always use the destination or the ship-to address to make the taxing determination. I want to spend a couple of minutes talking about how your company can benefit from tax automation. It's probably no secret you realize that Avalara, in putting on this web seminar, is a tax technology company. And I just want you to understand there's a trend in the marketplace where companies are using vendors like Avalara and others to automate their processes. There's some steps to think about before you automate, but the idea is to offload the manual workload to be compliant to experts. And we can talk a little bit about how that automation works. I'm going to keep this part pretty short, but obviously the value proposition for outsourcing sales tax, we talked about a little bit more, but it lines up very well with payroll outsourcing. Payroll outsourcing got very popular in the 80s where companies realized it's not a competitive advantage for me to do my own payroll. In fact, it's a bit more of a risk because if I do it wrong, I either have the government coming down on me from a tax perspective, or my employees are upset because I'm paying them the wrong salaries. And there's been a general trend where most companies nowadays outsource payroll compliance. But the same thing is true for sales tax. There's a real trend in the marketplace where companies are using technology to save them time and money, make sure that they're increasing their accuracy. As a result, they're able to dramatically reduce their exposure to losing money in tax audits. It creates a lot of efficiency in the business and allows them to redeploy resources that otherwise or previously were devoted to tax activities and put them on things that are more important, things that matter more to the business. I had put this together in terms of ways that you can kind of think about, is there a return on investment for you to invest in this type of technology? And as I was thinking about it earlier today, and in light of the time that we have to talk about, I thought I'd just share with you some insights that I've had. Having done this for the last 10 years in the tax space and before that dealing with accounting technology, I've yet to meet a company that's doing sales tax that isn't costing their business. Sales tax is a decentralized process, so what I'm telling you is that in order to nail down a concrete number of what that costs a business to do, it's very hard to come up with a real number to gauge off of. So I've relied on the Aberdeen study and other studies out in the marketplace that show what the average company does. But certainly the point I want to make here is that, regardless of how many states you're in or what types of items you sell or what kind of tax processes you have in place, there's nearly always a cost. And what companies can generally see is a lower cost by using an outsourced leverage technology. And once those processes get automated, the way that looks is that companies can eliminate having to research tax rates, build tax tables in their systems, research items and services and how they're taxed. They can eliminate their onus on running reports and filling out forms and cutting checks and paying states. And they can eliminate the whole process around collecting and storing and managing certificates. It really becomes an end-to-end compliance model that allows businesses to be efficient and focus on the things that make them a better company, make them a competitive success, and provide value to their customers. So certainly, Morgan and I hope that you've benefited from this presentation today. I know we've covered a lot of concepts, and it's probably raised a lot of questions. I know Morgan's been keeping track of those. But more than anything, we just want to familiarize with you the basics of sales and use tax and what companies need to think about. If you're a new company and you're just tipping your toe in the water in terms of getting compliant, I hope you find some good information. If you've been around the block and you've done this for some time, I hope we provided some useful tips for you in terms of upping your game. So with that, Morgan, I think we're going to go ahead and turn it over to some questions. And again, if we don't get to all the questions today, we have a pretty large audience. We will make an effort to review the questions and get back to you personally. So.
Mark, that was great. Thank you. That was very informative. So we have a little over 10 minutes here where Mark can devote his time to questions. I'm just going to go ahead and open up the console for him so he can see these questions a little bit better, and we'll start going right through it. All right, go ahead and take it away, Mark.
Okay, and I'm just reviewing the questions, and I'll start with some recent ones here. And is that, Morgan, really quickly, is that interrupted or is that just incomplete? That looks like it's incomplete. So one of the questions here is, what about online sales? Apologies if you've addressed this already, but what if you sell through Amazon but keep your product at your own place of business? What does that mean? And I'm assuming that's from a Nexus perspective that they're asking that question. And generally speaking, to be a partner of Amazon, certainly you don't have to use their warehouse facilities, so there really would be no impact. If your products are in your own warehouse and you're selling through the Amazon marketplace, certainly in the states that you have Nexus, you're required to collect. But if I understand the question well, simply selling on Amazon is not a Nexus driver. But do be careful if you start using their fulfillment services, want to be part of their Prime program as well. Let's see. There's a question here. Oh, this is great. Elizabeth says, I have my graduate in economy and master's degree in business, but it's mostly been outside of the U.S. She's taken trainings before, but wonders are there sites or areas where she could get more information and things like that. And Elizabeth, what I'd say is feel free to jot down this web address. It's help.avalara.com. If you go to help.avalara.com, not only do we list webinars like this where you can attend courses and in some cases get CPE credits, but there's also tutorial videos about sales tax and sales tax concepts, and there's just a wealth of information there around tax as well as tax technology. Let's see. I see a specific question that I'll probably route to our one of our sales engineers around different products used in the manufacturing process. And there's some questions about a particular type of product in that process, whether it may or may not be taxable. And I'll probably defer that to getting you a more specific answer or getting you in touch with one of our people, Bill. Another question that typically comes up is, well, maybe I've learned something from this web seminar, but I don't know everything. What do I do? And I just encourage you, Avalara is in the business of selling tax technology. As a part of that, we certainly help clients get what we would call tax ready, meaning that we can provide consulting services around helping them understand their nexus or doing research around different aspects of their business to help them come up with the right tax strategy. That's certainly not unique to Avalara. There's many, many accounting firms out there that have state and local tax groups. There's state and local tax practitioners out there and businesses that can provide a wealth of information. If nothing else, it's probably a good area to do a little bit more investigation. I'm certainly not giving you tax advice or telling you what to do with your business, but we want to make you aware of what to think about. And if that leads you to a path where you need more information, call Avalara. Even if it's not related to our technology, we'll be happy to direct you to the right resource. One of the questions is, what if I had a location in a state but we closed it? Do we still have nexus in that state? I'm going to tell you that you'll want to do some research around that because there's a concept called trailing nexus, where if you had a sales rep or a store in a state and you've closed that down or that person has quit or been let go, that the state may require you to collect tax for a certain amount of time based on the sales effort, the marketing that you are making in that state. So the key term that you'd want to look into there is trailing nexus. Here's another question. Can nexus be created by a salesperson simply visiting a potential customer in a state? I'd say potentially it could. Met people that work for Amazon.com, and the amount of the spotlight on Amazon as it relates to sales tax with states like Illinois is pretty amazing. So I've heard that Amazon has sent out internal letters to their employees that when they're on a flight, first off, they're forbidden from attending business meetings on site with a customer in Illinois. But even if they're taking a flight that has a layover in like O'Hare, they tell their employees not to check their email because that could create some gray area with the state in terms of attempting to do business there. So that seems a little bit extreme, but certainly making sales calls in certain states can create a nexus. Let's see here. Let's see. One of the questions says, as a CPA that helps clients with tax issues, how would I add this to my business? How do I charge for it? How do I benefit from recommending Avalara? And that's a great question, Barbara. What I would say there is that I'd encourage you to give Avalara a call, or we'll reach out to you, because Avalara does have partner programs for accountants where we have free tools that we can provide you to educate you on these topics and provide you tools to help your customers, specifically as it relates to our technology. There's a variety of ways that we can work together, but we'd love to have some conversations about it. So I appreciate your reaching out on that. There's a question here from Michelle that says, do you have a seminar where we can see how your product works? And the answer is absolutely. We do fairly frequent web seminars on AvaTax, is the core name of our product, where we demonstrate how our tax calculation systems work, certificate management, returns. We'll make sure to personally invite you to that, Michelle, but certainly if there's others that are interested, check out our website at Avalara.com, and I believe there's an area called Resources on the site that has a link to web seminars and so forth. Cordell asked, will this presentation be available in soft copy? I don't know if you heard this when we mentioned it, Cordell. You can download a PDF right from within the console there. We're going to make a recording of this presentation available, and I would assume, based on your comment here, that Morgan and I will make sure you get a copy of the presentation. So by tomorrow, we're on that. Let's see. Someone asked, what is the cost of Avalara? Avalara's costs are based on typically usage, so it varies widely. We have companies that are on QuickBooks, and they're very small businesses doing a few hundred invoices a year, paying a couple $100. We have very large enterprise companies that are doing millions and millions of transactions where the cost is in the hundreds of thousands of dollars. To give you some kind of guide without knowing the specifics of the client or business that you're asking about, our average sales price is typically about $10,000 a year across all of our customers. So that's a pretty wide swath, but that may give you a good idea. Typically, based on the client's need, the cost is not a concern because of the usage-based models. Carrie asks, is Avalara able to help with a Nexus study? And the answer is yes. We typically provide Nexus studies for customers or prospective customers of Avalara, where we can do a survey with you to understand what business activities you're doing, and we can actually give you the citations of any activities that you're doing that are creating Nexus specifically to the various states. Someone asked, I collect many multi-jurisdictional sales certificates. Are these valid? Yes, you're right. I think it's UGO, if I've pronounced that correctly. There are multi-jurisdictional exemption and resale certificates. I know that Streamline Sales Tax has a multi-jurisdictional certificate. California and several other states participate in a multi-jurisdictional certificate. So yes, those could be certificates that you see. They should be valid. Someone asked, what is the status of Streamline Sales Tax rules? Well, Streamline Sales Tax rules, for anybody that's not aware, is a consortium of states. There's 24 full member states that have aligned their laws to some level of uniformity with the idea of being able to get more taxes. There's some benefits for companies that comply with Streamline Sales Tax or participate in that process as a business, where there's audit relief, there's some subsidy if you're considered a volunteer collector in certain states that you could take advantage of. Where the Streamline Sales Tax is at, so far as I'm aware, is they haven't added any new states just recently, but all states are participating in conversations. The popularity of Streamline Sales Tax continues to grow, at least what we see in our business. But also, it's got a lot of momentum going around these initiatives around federal laws to tax sales on the Internet. Let's see. I have some specific questions here that are probably better to take offline. Someone asked, do you have to have an updated resale cert every year? And that actually depends on the state. There's some states that have expirations, some don't. One of the things you can do quickly is if you go to the Department of Revenue, and I typically type in resale expiration, you can get a little bit of an overview usually from the site as far as how long certificates are valid for. The one thing that's a little bit confusing, this is a business policy question, is certificates typically are not valid once the business changes. So if one of your clients changes ownership, or they change the business name, or they change their address, you'd want to stay in touch enough to collect those documents. You might tell me, well, how do I know that? And so what we've seen customers do is, even if certificates don't expire in a state, they set up a process to collect a new one at least every 3 years. So they make sure that their documents aren't outdated, and it seems like a reasonable approach. There's some comments here. Someone says, how in the HE double hockey sticks can we take care of this ourselves? I don't mean to be the bearer of bad news. Understand that I am the messenger. But there's companies like Avalara that can help you. So if I've raised some concerns, don't stress out too much. But do some research, reach out to us. We could point you in the right direction. And I think at this point we're now a minute over, and so I know the rest of you have things going on with your day. Once again, thanks so much for devoting the time to this seminar. I hope you found it helpful. And again, if you need some direction, you have questions, whether it's not related to our technology or not, feel free to give us a call. We'll be happy to point you in the right direction. Again, those resources available out at our website at avalara.com, specifically relating to webinars and training tools. Visit help.avalara.com, and we hope to see you in another web seminar soon. So with that, thanks everybody. Much appreciated. Have a great day.